A2IM, the collective voice of independent music.
Hi, everyone. Welcome to A2IM's Spotlight on Finance panel. This particular discussion will be about business valuation and determining what your business is worth, or at least helping you to determine that. I'm Glen Barros, and before we get started on the topic, I'll give you a little background about me. So I've spent my whole professional career in the music business. And for the last 25 years of that career, I was at Concord. And I got to Concord really in 1994 when I started the process to acquire the label from its founder for the company I was working for at the time. And I had been involved in a couple of other acquisition processes before that, but Concord was the first deal I ever led. I really managed it from start to finish. And I knew I loved the label. The label had been around for 22 years at that point. And I loved everything it was about. Knew that musically it was something I wanted to do. But I needed to learn the process by which you value a business first to arrange at the right deal and then manage the process to actually get it done. So shortly thereafter, I became the CEO of Concord. And over the next 25 years, we grew dramatically via organic growth, doing all the things that labels do, signing artists and so forth. And we also grew by acquisition. And in the last several years, Concord significantly grew through acquisition. And so over all those years, prior to Concord all the way through to the end of last year, I must have been involved in over 40 major transactions, all of which were rooted in a process that really starts with valuing a business. And so that's the topic. My current activity is I left Concord at the end of last year. The company's doing great and is on a roll. And I wanted to try something a little different, to create a new kind of company. I love the independent community. I love the fact that what labels do is develop and promote artists. And so I thought I want to start a business, which I've called Exceleration Music, which helps to develop labels, invest in those labels, and then provide some strategic guidance, some operational support, and things that maybe are needed in the indie community. And so I started by buying an independent label at the beginning of this year called Candid Records, a great jazz label. And I'm really going to launch the business right now. It's been a little delayed by the situation with COVID-19 and so forth, but the business will launch more formally later in the year. But certainly as a part of that, it will be very much rooted in the process we're going to talk about today, which is, you start with a belief in the music, and then you have to get to the business end. And I've always loved the phrase, no margin, no mission. And the reason I bring that up is because I think, what is the business worth? That question really starts with, where does a business come from? The worth of a business is not determined by how much money it makes necessarily. But I'm sure that the purpose of most of your businesses and most labels is to help to promote and develop the music that you love. And there's no shortage of passion in the indie community. And so I know that first and foremost, it starts with that. And if you don't have great music and you don't do the job well in terms of developing artists and promoting that music, then you don't succeed. But there's another element to it, which is fundamental to all businesses, which is that financial element. And certainly in the music rights world, there are specific circumstances and attributes that need to be better understood. And if they are, it can help you develop your business. So I'm going to share my screen with you for a presentation, and you don't have to look at me for the next 20 minutes or so. And I want to start by really looking at what are some of the key terms. We're going to talk about how you value a business. And there are a lot of terms that many of you know, and if you do, I apologize, but I think they're worth going over. And the concept behind them is worth mentioning so that you understand how this process works and how you might apply it to your business. So the first one is fair market value. And that really is trying to get at the price by which a willing buyer and a willing seller will transact, right? So it's if there's no duress, no special circumstances, just open market, what is someone going to buy and sell something for and come to that agreement? Which is great because that's the truest way to get to value, except for one problem. What if you don't have an open market like that, or you're not interested in selling? You just really want to know the value. So to get to that value, there's a process that you can use, which will help you arrive at an indication of what fair market value might be. So the next term is, you have to decide what value you're trying to arrive at. And the highest level of value of any business is its enterprise value. That's the total value of the business, irrespective of its component parts, meaning you may have debt, and you have equity, but this is the enterprise value, which includes all of that. The second level of that, of course, is the equity value. So that says you take the enterprise value and you back out the debt, and you'll get at what the owner's share is, and we'll talk more about that in a little bit. Another key term is going concern. Now, for record labels, going concern value is the value that it has from its general operations, from what it does. It has artist contracts, it has relationships, it has a history, and year after year, it has an output. And what is the value of that output? And so the machine, so to speak, that creates that value. The next is book value, and that's the value of the assets. Now, technically, the definition is you take your assets, you subtract your liabilities, that's your book value. But for rights-based businesses, that could be misleading because the book value, according to accounting rules, are what you put on your balance sheet for what you actually paid for the asset. And so for rights, the actual market value might be very, very different. And so the balance sheet doesn't usually tell the whole story, and you need to do a separate rights valuation. And once you value that intangible property of the rights value the record company has, then you can subtract out the liabilities and you get to book value, or what I would call net rights value. We will talk more about that later as well. The next term that's really important to understand is net label share or net publisher share. These have become very commonly used terms in the business as it relates to valuing a business. What they really represent is the cash flow that rights generate before overhead. So for publishing, it's very simple. It's usually gross profit. It basically takes the revenue, you take out your songwriter royalties, you get to gross profit or net publisher share. For labels, it's a little more complicated because there are more elements to the gross profit equation. You have distribution costs, you have publishing or mechanical royalties, you have, of course, your artist royalties, you have manufacturing and so forth. And so I would even include marketing because marketing helps to drive that revenue, and without it, you're not going to get the same level of revenue, presumably. I would also include recording costs, the cost of creating the master, and which, again, on the publishing side, it's a very different structure. So all of that leads to net label share. But the concept is really that you're trying to get at the cash flow that rights generate before a cost structure of overhead, because anyone managing rights may have a very different cost structure. The prime example is if you had a small catalog and you had a team of people managing that catalog, but then you gave it or sold it to a large company who had a big infrastructure, they might be able to absorb that catalog and not incur any incremental overhead. So overheads are relative to the individual entity, whereas the rights generate what the rights generate. And so that's why you go to look for net label share and net publisher share. Another key term is internal rate of return. This is the rate of return that any investor looks for in making an investment. It's essentially if you had a bond, and that bond we're paying 4% interest per year, and every year you got the same 4%, well, that's the rate of return. Obviously, if you have rights that are generating different amounts per year, there's a mathematical calculation that you can use to essentially determine what that average rate of return is over a period of time. And that is usually important in the valuation process because it's what an investor looks for to justify an investment or to justify value. And then the last term we'll look at here is discounted cash flow, which is really that process that I just described of if you have a stream of expected cash flows over a period of time, you have a required rate of return. If you discount that back, and counting for the time value of money, what's it worth today? And that's essentially how you arrive at value. Now, let's take a look at the basic process for getting to the value of an entity. So the first component goes back to that term I mentioned earlier, going concern. And the going concern value is usually harder to get at because it involves a bunch of unknowns. It's the ongoing operations of a business. And so, a business may have certain known things like artist contracts and records that are going to come out, but you really don't know what's going to happen after that. And you don't even very often know what those records might do. I mean, you can look at past history as an example. You can look at relationships. You can look at what's been done over time. But what this is it's the operation and it's the value of that operation. And so that's one component of how you value a business. If you are looking at going concern value, what you're trying to use is the profit picture of the business. What's the EBITDA, or earnings before interest, taxes, and depreciation and amortization, or the net income. Those are what really matter because you're looking at the whole operation. The other key valuation metric, which is usually much more of the one that you use and you're focused on in the valuation process, is rights value. And this is the value of the existing copyrights owned or controlled by a record label and or music publisher. And for this, it's a lot easier to get to a value because you do have a history and you do have a sense of trend for what these rights are generating. But the process is essentially the same. You're then sort of projecting out into the future. Now, if you add those two things together and look at both collectively, you get to the enterprise value of the business. And then once again, going back on our conversation regarding the investment terms, out of that enterprise value, you have to remove the debt. So this is whatever you owe to a bank or to a third-party lender. You then have other assets. You have working capital, which are your net tangible assets, cash, receivables, inventory, and other assets that might be real. And then you have actual liabilities. You have your royalties payable, you have accounts payable, and so forth. When you subtract one from the other, you may have a positive or a negative number. But after that, when you factor in debt and working capital, the remaining value is your equity value. So this working capital and equity value is essentially the net worth to the owners. Again, working capital can take it in either direction. But you take your equity, you adjust for working capital. That's going to get you to what that value is. And so, of course, the real key is now how do we get to determining what the rights value is and or the going concern value. And in either case, it's essentially a process which is a little art and a little science. And the art part of it is that you really are predicting the future. You're looking at the past, you're looking at the market, you're looking at whatever known information you have, and you're essentially trying to forecast what's going to happen in the future. So that is step one in trying to get to a valuation. Now, once you have that, you forecast your future cash flow. So going back to net label share, net publisher share, you literally say, okay, here's what's happened in the past with all the information I have about the market, about the business. Here's what I think is going to happen in the future, and you plot that out. The next thing you have to determine is what's the likelihood you're right, and if you're wrong, how wrong could you be? And you look at the tolerance on both sides of that. So, what's the upside? I could be wrong. Things could go way better than I thought. So that would be great. On the downside, how bad could it get? Could it be a complete wipeout, or is it just I'm off 10%, 15%? What's the worst case scenario? And that determines your volatility. It also determines the risk of the investment. And so with that, you can then get a sense of what you need in the way of a return to justify that risk. And that return, is usually compared to other investment opportunities. What else could you put your money into? As a rational investor has lots of options, and this is about trade-offs, right? So, if you think of the stock market, for example, historically has returned somewhere between 8-10% over the long term. So, if that's obviously there's risk, but very diversified risk if you spread it across the whole market, and it's liquid, right? You can get your money out. So, if you're investing in music rights or a music rights-based business, you might logically want a higher return than that because usually it's illiquid. You can't just easily sell your shares. Also, it's not diversified, right? You're in one kind of business. I mean, you might have lots of different types of rights, and that might be diversified, but you're not in lots of businesses. So any individual investment would require, logically, a higher return. But that's all specific to the situation and to the investor. But you use the risk of the business to decide what it is you feel you need to make to justify the investment. And then with that, you create this discounted cash flow analysis, which essentially you take your future predictions, you determine what the IRR is to justify the risk you've assessed, and then you plot out these cash flows over time and discount it back at that rate. All of this is the work of finance people, right? This is sort of a classic financial exercise. And for label owners or music people, it can be a daunting and difficult process. And so rather than have to constantly rely on finance people to go through this and determine what your value might be, there's good news in that there's a shortcut. And it's the one that you hear a lot about in the music press. And that's basically to use a market multiple. So you take your cash flow, your NLS, your MPS, and you multiply it by an approximator of that IRR. So to use a simple example, internal rate of return, if you had a flat cash flow, say you were earning 12.5%. That was your required IRR is 12.5% over time, and you had a flat cash flow where you're getting the same amount every year. Well, 1 divided by 12.5% is 8, so you would pay 8 times that, and you'd be getting your 12.5%, and that would be your multiple. So that process is often used, but the issue is that there are many factors that affect cash flow, and so you can't basically just assume that there's one multiple that fits every situation. That is absolutely not the case. There are many factors that affect what market multiples might be used to your business or any particular business or any particular set of rights. One of the key factors there is age, right? So rights tend to generate a lot of revenue in the beginning, and then it drops off and falls into a catalog type plateau. So if you are very new rights, obviously you're going to get a much lower multiple. If you have mature rights, you are going to get a higher multiple. Another factor is term. This is a key one, of course, because if you own your copyrights and you have the whole life of copyright, and there's a long time before it expires, well, then you're getting that whole long tail into the future. If you have a short term, or you've licensed it, or you have a reversion clause, you literally go to zero at some point in the near future, and so you're obviously going to get a lower multiple for that. After that, you have the specific consumer and market trends. Multiples go up and down based upon growth, right? If going back to that scenario of 8 times to get 12.5%, that assumed flat cash flow. But what if the cash flow is going up every year, right? Then you'd pay a higher multiple and you'd still get that same rate of return. The reverse is true as well. And one other key point here is this is not just the macro market, what's happening in the music industry, for example, but it's going to be segmented by the type of music. Streaming's been driving growth, of course. When we look at the various genres, a genre like hip hop has grown, way faster than other genres like, say, blues or classical or even rock. And so, obviously, those trends are going to affect the multiple that would apply to any specific set of rights. Integration and administration. This is, if you have a collection of rights that would be easily integrated into another set and are easy to administer, not a lot of complicated deals, not many operational challenges or restrictions, that's a good thing. There's more versatility. You're going to get a higher multiple. If you have uncommon deals, or rights that are very difficult or they're marketed in a different way, you're likely to get a lower multiple. The way in which rights have been managed also factors into this. Rights that have been managed exceptionally well, where every penny was squeezed out, you're going to get the base multiple. If, on the other hand, someone were to look at it and say, well, there's a whole bunch of things that haven't really been done very well or very efficiently, or maybe there are costs embedded in there that didn't have the benefit of scale, you may get a higher multiple. Although, word of warning, if you're actually trading a catalog on the market, the likelihood is that a buyer wants to get that benefit for themselves, so they don't always assume a higher multiple. But it certainly factors into the equation. And then last, there are the anomalies. There are the situations where there might have been an uncommon, one-off type thing or non-recurring type thing that you really can't get a multiple on. So the classic example here is the big sync fee, right? You look at your past history, and 1 year there's a huge spike because you were fortunate enough to get a great sync placement. And that's terrific, except you can't assume that's going to be replicated in the future. And so that's usually either taken out of the cash flow or the multiple is lowered on the prior cash flow. On the reverse side, if you have a catalog that's prone to those type of things, then you might get a little more because people assume that there's more upside than downside. So all of these things add up to what that multiple is. So with that, let's take a look at an example. I've created in this chart that's on the screen now, essentially a hypothetical sales curve for, let's call it a group of rights. It could be one, it could be a group, whatever. And also on the left axis, I put it at $100, but you can use any order of magnitude that you choose to apply, $1,000, $10,000, $100,000, million, whatever. This is obviously not every body of rights or every master, but it essentially is a good, I think, example of how revenue is generally derived from a master recording. So the hypothesis here is this record comes out in 2021 and you get, your new release billing, and then the next year you get a fraction of that, and the next year you get a fraction of that, and it gradually comes down. And after 4 or 5 years, it hits its catalog phase, which is, it starts to plateau a bit, but then the assumption, and we all hope this is true, is that the market keeps growing, maybe not at the rate it's been in the last few years. But it keeps growing as streaming grows. It keeps up with the rate of inflation at least. Then you get this modest growth, into the future. Of course, revenue is not cash flow, so we have expenses against that. And so there's a list of all the expenses, the recording costs, then artist royalties, distribution, manufacturing, so forth. And again, of course, in year one, they're greater than ever because you have the cost of the record, you have the cost of the release marketing, and so forth. And then they plateau as well, and you have a fairly consistent cash flow, which may change, due to certain trends or industry circumstances. But essentially, you get this blue band of cash flow that goes off into the future. Now, from that, you can do the DCF analysis. Now, we're not going to, because we want to try and get at what the multiples are that are inherent in that DCF analysis. But I did the DCF analysis. And if you do it, and then you plot it on this chart, here's what it looks like. This is the value over time. So this green line starts where when the record's first released, here's its value. And it comes down as cash flow drops. And then when it hits its catalog phase, it plateaus. And then because the market keeps growing, the value keeps growing, which is good. If you have an asset, you want it to appreciate over time. And that's exactly what happens in this scenario. Now, if we're looking at this on a multiple basis, now we're going to go from the left vertical axis to the right vertical axis where you have multiples here. And we're going to plot that. We're going to take this value and divide it by the cash flow. When we do that, here's what you get. So what this shows is the cash flow in year one divided, the value of the cash flow divided by the cash flow gives you a multiple that's sitting at less than 4. And then as you move forward, this multiple goes up until you get to the catalog phase where it plateaus. Now, what I've assumed in this scenario is that an investor or someone valuing this would want a 15% rate of return. It could be more, it could be less. This is really just for illustration purposes. But what it shows is that with modest growth, when you hit that catalog phase, you are very much in sort of an even band here. And so once you get there, you're sitting between an 8 and 9. So if 15% was your required IRR and the market were growing modestly over this period of time, then this particular set of assets would essentially have a value of about 8 to 9 times its net label share. Again, I'm assuming this is a master recording catalog, but the same kind of concept could apply to publishing. Now, before we move on, there's one other topic here that is really important, which is to show what happens when you have reversion. So this assumes that you own the copyright for the life of copyright and you have a nice long term. But what if you did a 10-year deal, which is not necessarily that short of a term, right? But you have a 10-year deal, and then the rights go back to the artist or whoever you license them from. Well, here's what that picture looks like. As you can see, the value is now this yellow line instead of this now ghosted green line that was the overall value of the master. And because you don't get that long tail, your value drops, pretty much straight down over that 10-year period. And your multiple starts out lower. If you remember, under the former scenario here, you have it closer to 4. Here it's closer to 3. And the reason for that is that long tail added value. And now you don't have it. So it starts out here. It bounces up a little bit to 4, and then it just starts dropping straight down until, of course, when you get to year 10, when it is 0. And so I think you can see if you, again, the reason we talked about a couple of the key factors in multiple valuations, age gives you a higher multiple. Over here, you're sitting at 8.5 times versus 4 times. And reversions have a huge impact, obviously, because if you're sitting here, you have at best a 4 multiple, and it's usually dropping as you get closer to that reversion period. So I hope that gives you a sense. Now, for your purposes or for purposes of valuation, I think my advice is you have to look at your own business and look at your circumstances, look at what the complexion of your rights are. Are they more new or more aged? Do you have reversions? If so, what percentage of your revenue comes from reverting titles? What are all those other factors that I mentioned? And then you can kind of get to a multiple. So, of course, you have to also understand where the market's at. There's a lot in the press that kind of gives you some guidance. Obviously, I mentioned that usually an investor wants a rate of return that's a little higher than the stock market, so you can kind of get at those, for seasoned masters and seasoned rights, you can kind of get that multiples are going to be in that higher range, and when you have all those other opposite factors, you're going to get into a lower range, and you can apply that to your business. Of course, the question is, why is this important? What's the point of this? And how do you apply it? How do you use it? Well, there are several reasons that you can, or 7 ways that you can apply this, and this is important. First one is if you want to outright exit the business or create some liquidity. All owners at some point need to find a succession plan, want to turn the work that, and all the equity they've built in a business into cash and move on. Obviously, valuation is at the core of that. You want to know what your business is worth. You want to know that when you go out, you find, especially in the case of record companies, where often if there are legacy issues, and you don't necessarily want to just throw it out to the open market in an auction. And so when you're in that process of, I'm trying to find the right future home for this that I've worked so hard to, this entity that I've worked so hard to build, you want to know what you want to have a good sense for what it's worth. So this is really important. The next reason is to raise growth capital. Just like a home equity loan where you have that equity in your house and you want to remodel, you want to build, keep building, you want to tap into that equity, you can do that with a rights-based business. If you have rights, you can borrow against them. Banks will lend a percentage of the value of the rights, and this process becomes central to that whole way of going out and raising debt. You can also sell pieces of your business. You can sell rights, you can sell parts of rights, you can have an investor in your business. You need to know what it's worth. You need to have a good handle on that in order to determine how and how to do it and what your options are. The next reason is for acquisitions. As I mentioned earlier, my career has been based both in building labels, from within, and also in acquisitions and then merging those acquisitions in to build a bigger entity. And those opportunities exist, of course, for both sides. You want to know what your business is worth. You want to know what a business you might hope to acquire is worth and how to put that together. So those are all more situational circumstances where you need to do something. You need to exit, you need to grow, you need to acquire something. But I think there's even a more overarching reason to be very in tune with what your business is worth. And that's this one. It's to understand your true financial performance. As I started out and mentioned when we were talking about the valuation process in general, the value you create every year is not self-evident, right? You may spend let's just throw out a number, $25,000 on a master, and it goes onto your balance sheet there, and then that gets amortized or depleted by recoupment or however your accounting process works. But if you create $50,000 worth of value, which is all tied back to that process that I mentioned earlier, that $50,000 doesn't show up on your balance sheet. So it's entirely possible that you could have an operation that after you factor in your overhead has a negative bottom line cash flow. And you might think you're in bad shape, but in fact, you've created a bunch of value that actually means you had a pretty good year or you have a pretty good run. And so until you determine what that value is and how it's evolving relative to the market and all other circumstances, you really don't know how you've performed. And so that, to me, is an essential element in this business. It's essential to really understand how you're doing and what's happening in your business and what your options are. If you do want to grow your business or raise capital or achieve liquidity, you need to know where you stand. And so I think this is part and parcel of business. I think it's an essential element. I think it's an essential element of all businesses. And I think in music, again, it doesn't take away from the prime purpose of a music business. We are all in it because we love music and we want to promote music and live our lives within it. But at the same time, all businesses have economic foundations, and it's best to make them as healthy as you can. It's best to start by understanding them, intrinsically. And so that's what this is all about. And I hope with that, this has been useful. I believe there will be some questions and hopefully I'll have answers for you. After this recording is over, we'll go live with those questions. But nonetheless, I want to thank the A2IM staff. They're fantastic. I'm glad they were able to turn this difficult world we live in right now into a virtual world for us in Indie Week, and we were able to gather this way. I certainly hope that next year we'll be able to do it in person. As for me, again, I'm happy launching this new business. You'll probably hear more about it in the fall as I get things up and running. But in the meantime, if I can be helpful to anyone in the indie community, or especially the A2IM community, the best way to reach me is probably through A2IM. Staff all knows how to get a hold of me. But before then, I'm happy to answer any questions you have in the remaining time we have here. So thank you, everybody, and hope you enjoy the rest of Indie Week.